What is bond? In this video, I'm going to share everything you need to know about bond. You may not necessarily be a business student or an analyst for you to understand bond. So that's why I actually dedicate this video on bond. Now, I had to also do this because one of the major indicator one of the leading indicator of the direction that will determine the direction of the financial market, the stock market, the cryptocurrency market, commodities market, or any other market you trade is actually bond yield. That's the secret. So I have to dedicate a video. In the previous course, you've learned everything you need to know about bond, inflation, interest rate, stock market, and all that. But today, I want to share everything you need to know about bond itself. So this is more or less like an expanded course on bond market. Now, what is bond? Bond is a debt instrument. So that's the simple definition of bond. Bond is a debt instrument issued by a borrower, so to investors. So if you want to borrow money, you issue a debt instrument. That instrument is called bond. So for the government, they actually issued out this particular debt instrument to raise money. In Nigeria, I'm sure you've heard of federal government bond. We also have the US government bond. We also have the China or Chinese government bond. We have the European bond. So every economy, every government have their own bond because whenever they want to finance a project, majority of the cash will not really come from the money that they have. So they want to borrow money to finance, hoping that they are going to be paying interest on the money they have borrowed. The same way you go to your bank to borrow money, that's how this government also borrows money from investors. So these investors can be private investors, can be private bond firm, it can even be institutional investors. There are companies or there are finance firms that are specialized in giving money to the government. So these ones they specialize in taking money from private investors or their shareholders and then investing majorly in government bonds. So they invest in bond across different regions. So there are mutual funds like that. So some of them can be we call them bond fund. So others can be equity fund. This one's they put money together to invest in equity. So for the purpose of this course, we're going to be looking at bond itself. Now, when you borrow money from investors, you are expected to pay interest on that particular fund that you have borrowed, on that money that you have actually assessed. So the interest you pay on that money is what we call coupon rates. So coupon rate is actually interest you pay on the money you have borrowed. So sometimes you see some updates, or you can even receive a mail if you actually have an account with a broker. You receive a mail, you say, oh, the federal government, the UF government is going to issue bond of $10 billion or 10 billion naira with a coupon rate of 11 to 12%. So what that means is that the rate the interest you're going to earn on that money is 11%. So we call that coupon rate. Coupon rate is like your interest rate, and this coupon rate is mostly driven by the interest rate. If you've watched the previous course, I talked about how interest rate is a major driver of the cost of borrowing, the cost of lending across board. So if your bank is going to borrow you money, if the bank is going to lend money to another institutional investor, if the bank is going to access funds, so whatever rate the bank is going to charge already has interest rate at the center. So when CBN or US Fed or any other government of economy increases interest rate, then that's likely going to drive every other rate in that economy. So one of them is the coupon rate. So if interest rate becomes a lot higher by a certain basis point, coupon rate should also go up because the relationship between interest rate and 10-year yield is um is positive, meaning that when rate increases, then you expect it when interest rate increases, expect coupon rates to also go up. Now, price is what you pay to access that bond. So most times you see them say that you can only access this bond in multiple of 10,000 or in multiples of $5,000. Let me explain this again. Now, what this means is that if you want to buy that bond, if you are interested in buying that bond, then the minimum you can buy is 10,000 naira or $5,000. That's the multiple. So if you want to buy in let's say 100,000 naira, then you're looking at 10 multiplied by 10. Here you can say I want to buy like 50,000 US dollars. So there's nothing like 13,000, there's nothing like 17,000. That's why you can only buy in multiples of 10,000 naira or 5,000 naira. So this is the price of the bond. You understand? This is the price of the bond. So if I'm going to put in 10,000 naira and then I'm going to earn 11.5% per annum, then the interest rate on that bond will most likely be like 1,150 naira. So that is what this is going to be. So 1,150 naira. So 1,150 naira, which is the coupon rate, that's the interest rate, divided by the price. So coupon rate divided by the price of the bond is what we call bond yield. You understand? So the bond yield is the coupon rate, which is the interest you earn on that bond divided by the price. The same way you calculate your dividend yield. Dividend per share divided by the price of that share is what we call dividend yield. So the same thing you have here, coupon rate, which is the interest you're going to get from that bond, divided by the price of the bond. That's what we call bond yield. So one of the major driver of the market is bond yield. So whenever you see bond yield, bond yield, bond yield, like if I go to Yahoo Finance right now, and then you see treasury yield. You can see you might just be wondering what is treasury yield? What does it mean? 3.76%. What exactly does this mean? It's very, very simple. What it actually means is that if you divide the coupon rate by the price of that bond, coupon rate by the price of that bond, that's going to give you the yield. So what this automatically means is that if you divide the interest that that bond pays by the price, then you have this amount. So this is more or less like the return you're going to get from that particular bond. And this interest is mostly this return or this yield is mostly driven by the interest rate. So whenever interest rate is going up, whenever interest rate is increasing, then automatically, what does that mean? It means that the price of the bond will come down because there is inverse relationship. So when interest rate is increasing, the yield would also be increasing because the interest rate means that you're going to be earning higher return. And then automatically, when you divide the higher return by the price, then the yield would also increase. So the relationship between the price of the bond and the yield, they are in inverse direction. What I mean again is that if the price of a bond is increasing, let's assume this is 10, this is 1,000 naira. So let's say this the yield is 1,000 naira. So let me uh, put up something here. So if you have a yield of 1,000 naira or $1,000 divided by 10,000 naira, which or $10,000, which is the amount you bought, that will give you 10%. Can you see right here? So let's go back. This is it here. So the interest you're going to earn, assuming is 10%. So 1,000 naira or dollar divided by 10. So this 1,000 naira is the interest you're going to get for investing 10,000 naira. So 1 divided by 10, 10,000 naira will give you 10%. This 10% is what we call the coupon rate on that bond or the yield on that bond. So the yield on this bond is the coupon rate of 10% of this divided by what you are paying. So coupon rate is 10% divided by. So another day for coupon rate again, you can say yield because the coupon rate most times is the interest you're going to get on it. And when you divide the interest by the amount you are paying, most times you also get the yield on that bond. So how you need to look at it is what is the coupon rate on this 10,000? It's 10%, which that's 10%. 10% of 10,000 is 1,000 naira. So if I'm going to earn 1,000 naira divided by the price I'm paying, that will give me a yield of 10,000 naira. Now, assuming that this bond, which was 10,000 naira, the price now increase to 11,000 naira. So let's do this here. So instead of 1,000 naira here, divided by instead of 10,000, the price now increased to 11,000 naira. So what does that tell you? Then it means that if you do 1 divided by 11, you likely have 9%. So our new yield will be 9%. So let's also say 1,000 naira or dollar divided by 9,000 naira. So here, if you do 1,000 divided by 9,000. That will give us 11%. 11%. So let me use this to explain the relationship between the price of a bond and the yield of that bond. It's generally said that when the price of a bond is increasing, then the yield becomes lower. And if the price is reducing, if the price is going down, the yield tends to go up. So I want to explain the rationale behind the increase in bond. So when I say the bond yield is increasing, you are not confused to like, why is he increasing? What is happening? Oh, it's going down. I don't understand. So that's why I'm taking my time to explain everything you need to know about 10-year bond itself. So look at this first scenario here. I collected 1,000 naira by investing 10,000 naira, which is the price I'm paying. So my yield is 10%. Now, if I'm collecting 1,000 naira on a bond price that has increased to 11,000 naira. You can see, so from 10,000, it increased to 11,000 naira. What happened? The yield reduced to 9,000 naira. That means if the price increases, the yield is going to what? Reduce. If the price of the bond increases, the yield will reduce. Now, right here, assuming the price reduced, I'm going to collect 1,000 naira interest rate. Now, the yield, the price of the bond has reduced to 9,000 naira. What does that mean? It means the yield has increased. So, what does that tell us? It means that the price of a bond and the yield, they move in opposite direction. They move in opposite direction. So whenever you hear that the treasury yield or the bond yield is increasing, just know that the price of that bond is reducing. And whenever you see that the yield on the bond is reducing, just know that the price has increased. It's as simple as that. So a higher increase in price, an increase in price leads to what? A decrease in bond yield. A decrease in price leads to what? An increase in bond yield. So those are the things you need to understand. So the next question is, what actually causes increase and decrease in bond prices? What causes increase and decrease in bond prices? When bond prices is increasing, what does that mean? When bond price is reducing or is going down, what exactly does that mean? The answer is an interplay of demand and supply. The answer is an interplay between demand and supply. When people are buying an asset, when there is demand, higher demand for an asset than supply, what happens? The price will go up, right? When there is higher supply, when the demand is going down and supply is very high, what happens? The price will go down. So one of the major reasons why the bond price will either go up or come down is because of demand and supply. So when investors are buying more of bond, they are rushing to buy bond, the price of bond will be going up because demand is very high. Now, as the price is going up, the yield will also come down. Do you understand? I'm going to explain this later. Now, when investors are selling off their bond, they are selling off their bond. There's too much supply. That means the price of the bond is coming down. What happens? The yield will be going up. So, what exactly is the rationale beyond the demand for bond and supply and the supply of bond? This is where I'm going to share more light on this bond yield that you are seeing that is becoming difficult to understand for some people. But if you get this point, you'll be able to forecast any financial market because this is a leading indicator of stock and also cryptocurrencies. So if you want to be a profitable stock trader, if you want to be a profitable cryptocurrency trader, you must master bond yield because this is where the signal comes first. So if you are not careful, if you say I'm not concerned about bond, I don't want to invest in bond, but you forget that the first point of signal, the first point where you will get an idea whether the market is going to take a U-turn or continue in the direction is the bond market. So this is a leading indicator. Why is the bond a leading indicator? Is because when there is an anticipation that CBN is going to increase interest rates, what happens? Investors will start reacting to that. How do they react to that? When there is potential that they are going to increase interest rate very soon, do you know what it means? Investors will start selling off their current bond. Investors will start selling off their current bond. So let me also explain what I mean by that. You bought US bond at let's say 2.3% right here when interest rates is around, let's say, 1.5%. So interest rate is around 1.5%. That's the current interest rate. Now, if US government is saying we want to increase interest rates to 2.5%, you know what will happen? Investors that are holding this one right here will start selling off. Why are they selling off? It's because they want to key into the new bond issue. Why? Because the new US bond issue that will come into the market might come at 3%, which is a lot more attractive than the previous one. Do you understand? So let me explain that again. So we have a recent bond issue of 2.3% when interest rate was 1.5. And now there's a news that the US government will likely increase interest rate to 2.5, from 1.5 to 2.5. Why is US government increasing interest rates? Because they are fighting inflation. Did you see that? Because they are fighting inflation. So they want to increase the bond rate from interest rate from 1.5 to 2.5, just to take out money, to encourage investors to give them money, so that the volume of money in circulation will reduce. Now, if they are going to issue the next bond that will be issued after this 2.5% increase will no longer be at 2.3 again. It will likely come at 3%. So what I mean is that the next bond that will be issued after higher interest rates will be a lot more attractive than the old bond. So because the old bond will no longer be attractive again, investors will start selling off this old bond. Now, as they are selling off this old bond, you remember what I said? When supply is more than demand, the price of the bond will dip. So that's why bond price can dip from 10,000 to 9,000. And remember, if bond price reduces, then the yield will increase. So those people that actually that are holding this bond that is generating 2.3% will start selling off their bond. Remember, the interest on that bond is still the same. That is why this 1,000, 1,000, 1,000 is still the same. Meaning that if you buy this bond from me, you're going to be earning 2.3% interest. Now, because the supply of this bond is much in the market, the price of the bond will start going down, and that's where the yield will go up. So that explains the reason why when we see bond price go down and then you start going up, you begin to wonder what is happening. Is because investors are selling off. So whenever there's a news, there's possibility the Fed is anticipating rate hike or has announced that it's going to increase rate hike in its upcoming meeting or next meeting, investors will start selling off. The simple reason is that when there is higher interest rates, the next bonds that will be issued will be a lot more attractive, and everybody wants to invest in an attractive instrument. So why am I holding a bond of 3% when I know that I can sell off this bond and move to the next issue that's giving me better return at 3%? So that's why when there's announcement that there's going to be increase in rate hike, investors will start selling off their current bond so that they can key into the next one. And as they sell off the current bond, the yield on that bond tends to rise. This explains why you have been seeing increase why you have been seeing increase in bond price. So let me open this chart to explain that better. So that explains the reason why you have been seeing this increase in bond yield. You can see here. So this is bond yield, US government treasury, US government bonds 10-year yield. You can see how the yield is rising. Why is the yield rising? Is because price is going down. Why is price going down? Because investors are selling off their current bond to key into the next bond, which they think will be issued at a much or a better rate, because right now the rate is a lot higher than what it was before. The inverse is that whenever you see bond price go down like this, why is bond price going down? Let's look at this again. The reason bond yield, why is bond yield going down again? Yes, why is bond yield going down? The reason bond yield is going down is because investors are buying more bond. Look at the period where yield dipped from 10% to 9%. So if yield dipped from 10% to 9%, it means investors are buying up more bond. Why are they buying up more bonds? Two things. Number one, if the Fed is saying that we're no longer increasing interest rates again, we want to maintain the one we have, meaning the next one that will be issued will come at the same rate, will no longer be attractive compared to the current one. So they would rather want to buy in the current one so that they don't miss out on the opportunity. So the more demand for the bond, the higher the price of that bond, and then yield will start reducing. You can see right here. So that was explained when the US Fed is saying we are going to reduce interest rates, we're going to bring interest rate down. People will start rushing in to buy bond because if this bond is going to give us 2.3%, by the time they reduce this interest from 1.5 to 1% right here, the next bond that will be issued will come at 2% and no longer 2.3%. So you can see how a lower interest will definitely make the next bond come at a lower rate. Now, because this lower rate now will be far, far unattractive compared to the previous one, investors will start rushing this one that is attractive because they want to buy into the one that is higher. And as they buy into this bond yield, what happens? The price of the bond increases, then the yield goes down. So all these that I said explain the dynamics behind bond yield going up and then bond yield coming down, and how yield is very sensitive to interest rates. So everything you have seen right now explains the up and down movement in bonds. So now when I say bond yield is increasing, just know that investors are selling off their current bond. And why is the bond yield increasing? Because of anticipation that Fed will increase interest rates. Now, however, even though the Fed is not going to announce interest rate, because a time will come where the Fed will say, okay, interest rate is fine. We're no longer increasing rates again. This bond price will be driven more by demand and supply. And this demand and supply is responsible for the money flows you see right here. What is money flow? Money flow is when investors are moving money away from bond into equities or risky assets like cryptos, equity, or when investors are moving money from equities into bond. What makes investors to move money from equities into bond? The answer is very simple. When the US government is going to increase interest rates, it means the return from bond will be a lot more attractive. So let's explain that with two key terms. So we have what we call bond yield versus dividend yield. Bond yield versus dividend yield. When I put my money in stock, especially company that pay dividend, they're going to pay me dividend. So the dividend I receive or the cash I receive divided by price is dividend yield. When I put my money in bond, the coupon rate I receive divided by price will give me bond yield. So this one is risk free. Bond yield is risk free, meaning that my capital is assured. Dividend is not risk free because you can invest in dividend stock and the price of the stock will crash. So for me to be attracted to dividend stock, it means that the yield has to be a lot more higher than bond yield. For me to be attracted to bond yield, the yield has to be higher than dividend yield. And like I said, bond yield is mostly driven by interest rates. So if the Fed is increasing interest rates, bond yield will be attractive. So if bond yield is attractive more than dividend yield, investors will move money away from dividend stock or the stock market in general, and then they will invest in bond. This is also the reason why higher interest rates has not been good for stock market. If you check the chart of US stock from the beginning of this year up to where we are today, you will see that the chart has not been a lot impressive. You can see right here, we've seen massive dip from a high of 4,300 to where it is, 4,700 to where it is right now. The answer is very, very simple. It's because the return on bond yield has been a lot more attractive. Why will I put my money in stock where I know I can put the same money in bond and I will get better return while my capital is assured or reserved? So that is why increase in bond yield is very bearish for stock market and also the cryptocurrency market. So this bond yield is a major determinant of money flows. And as an investor, you need to know where the money is flowing to. So a sign that money is moving into bond is when there is increase in interest rates. When there's increase in interest rate, the investors will start moving money into bond because the next bond that will be issued will come at a higher rate. Then the old bond, the existing bond, they are going to sell off, and as they sell off, the yield increases. So this explains why bond is very, very important to understand in the market. So why is this a leading indicator? I've explained that before. The reason it's a leading indicator is because it tells you where money is flowing ahead of time. It's a sign that money is going to flow into stock and money is going to flow into equities. I can take my time to share several simulations of how this particular bond has been responsible for market rally and also market dip. So I can go as far back as 2021 to explain several market scenarios and how that this has helped a lot of investors to know where to put their money. So if you divide this into two right now, let's divide this into two. Okay, so this is the bond. This is the bond. So let's call this the SPS, which is the stock market. So if we go back to going back to this is August. So this is March. So you can see this is stock market. Look at the rally between October 2019. You can see October 2019. So let's see if we can locate that on this chart. October 2019, October 2019. Let's see what happened during that period, which is June. So this is October 2019, and then this is October 2019. This is the same period. So let's go back. Okay, so you can see the huge dip. You can see from here how that the bond price or bond yield went down from, you can see, between November 2018. So I'm going to change this time frame to daily to weekly time frame so we can have a better understanding of this period. This 2016. So let's look at this is September 2017. So if we go back here to weekly time frame, so this is September 2017, and US government bond, September 2017. You can see how it rallied to 2.5, and then this is the same period. So let's drill down to our daily charts. Trying to get something clear here. So because this works more on daily charts. Okay. So look at the recent times, and then if I switch this to our daily charts, so this works more on daily charts, especially for swing traders. So this works more on daily charts, especially for swing traders. You can see right here from August 2022, you can see the dip on 10-year treasury from August 2022 down. And then if you come here and we look at from August, you can see how the stock market, so this stock market, how it dipped, and then you can see treasury a rally. Like I said, increase in bond yield is always bearish for stock. Before then, you can see that we've had massive dip in bond yield between June to August. You can see here that also supported the increase between June to August that we had. You can see right here. So bond yield and stock market they move in opposite direction. So if bond yield and stock market move in opposite direction, how can I use this to my advantage? And this works more on daily chart. The best way you can use it to your advantage basically is to find a way to understand the trends of 10-year treasury yield. Where is it going to? That's the best way to understand it. Where is it heading to? Where is it right now? So for me to understand treasury yield, I like to use these two indicators. I use the ADS. I'm going to share more light on ADS when we talk about picking stock, and then the MACD. You can see that whenever we have a MACD cross to the downside, notice the MACD cross to the downside has always been one of the major early sign of a bearish run on the yield. So that tells you that yield is going to dip. Like right here, sorry, let's use 10-year yield. I was looking at SPS. So you can see here, the MACD cross to the upside has always been an early signal. Look at the time we had a run from 10th of August. You can see how the yield has rallied from 2.7 to a high of 4%. And within that period, there was a dip, a market crash. If you also go back to the period where we had a bearish cross on MACD, you can see how the yield dipped. If I go back to SPS also rallied within that period. Now you can see where we had a very long run between March, and May. That's how 10-year yield went up. And like I said, when 10-year yield is going up, it's a sign. It's a sign that what investors are selling off their current bond in anticipation of higher rates. That's what it means. They are selling off their current bond, and then the ones that have invested in stock market are also selling off their stocks in anticipation of higher rates so that they can put that money in risk-free return. So if I check the SPS between March and May, look at the SPS2 between March and May. Let's see what happened. SPS between March and May. So this is SPS. You can see here from March, look at it here. You can see from March, you can see how SPS is the index that tracks performance of top 500 companies in stock market. You can see how it followed with a down trend. You can see right here. So if you're looking at where SPS is going to right now, pay attention to the 10-year treasury yield. It will most likely tell you where it's going to. Now, as it is, you can see that we just recorded a bearish cross on the 10-year yield, a bearish cross on 10-year yield with DMI confirming that. What is DMI? DMI to tell us the strength of the market. So as DMI continues to rally higher, you see the market gains higher strength. So what DMI basically tells you is that the market is moving from weakness to strength. It doesn't mean that the rising DMI means that the market is going up. This white line, DMI, does not tell us whether market is going up or down. It only tells us the strength of the bull run or the strength of the bear run. How do you know that the market is going up? When the blue line plus DMI is higher than the red line. How do you know that the market is coming down? When the red line is higher than the blue line. So like you can see this period here, how the market dip. So what you just need to do is to check for the strength of the trend. Now there is an extent DMI will rally to, the market will lose its strength, meaning that that level is no longer sustainable again. And most times when DMI rises from 40, 45 to 50, it means that the strength of that trend is no longer sustainable. Most of the times, is no longer sustainable again. And then when you start seeing the strength come down, just the way you're saying here, what does that mean? It means that whatever move the market is recording right now, there is no strength behind it again. The market will definitely give up its gain. And then with MACD already showing a bearish cross, that also confirms the fact that this yield will likely dip. And that also will open up room for the stock market to rally to the upside, because you can see how this market had been down for a long time. So such bullish cross you can see right here is a sign that we might see a huge move in stock market. Like the last one we had between June, it went from June to August. That's like 2 months. So if the same thing is going to play out again, we should see the stock market rally from October up to December, because we have spotted a bearish sign on the 10-year yield. So all we need to do is to probably watch for a break below this low attained in October 1st. So if the October 4th, so the market breaks below 3.58, then expect further downward move going forward, which will be bullish for stock market. So this is how to forecast the stock market and also the cryptocurrency market. I'm going to shed more light on this DMI line and MACD when I talk about how to scan for stock and also how to scan for cryptocurrency. But this video is dedicated to bond yield. This is the number one tool you need to always check every week to know where the market is headed for. If investors are moving money into bond market, if investors are expected to move money into bond market in anticipation that the rate will go rate will go lower, then this yield will come down. But as the yield continues to rise now, it's a sign that investors are selling off their current bond, hoping that when the Fed increases the interest rate, then the next one will come at a higher rate. So this video explains how to analyze the market. So the easiest way to forecast the financial market is to pay attention to US government bond yield. It's a major indicator, it's a leading indicator in the market right now. So if you trade stock or you trade cryptocurrency, don't ignore this particular chart. This chart will tell you a lot about what is happening in the market. In short, this chart you need to know what institutional investors are doing. If investors are actually going to move money into the stock market, you should see this yield go down. So anytime we have a bearish cross, bearish confirmation in this market, then watch out for the stock market. Most likely, the stock market and the cryptocurrency market will rally. Like you can see right here, between June to August, if I check the chart of the cryptocurrency market between June to August, you can see how the same rally also pushed the cryptocurrency market from 848 billion to almost 1.14 trillion. And then the stock market also followed the same direction. Why? Because the 10-year yield actually went down. So anytime there is a dip in 10-year yield, you should most likely watch out for increase in stock. And if there's going to be rally in 10-year yield, watch out for decrease in stock. So you're now going to be paying attention to the interplay of demand and supply on this particular 10-year yield. So the tools you need to analyze this market is your moving average, that's your 20 EMA, your 50 EMA, and also your 100 EMA. So if all these moving averages are lined up with price above it, then it means that there's higher demand for this market, for this particular bond. So, and then sorry, that automatically means that the yield on this bond is rising. Investors are selling off their current bond in anticipation that the interest rates that will be interest rate announcement will actually help drive the next bond that will be issued. So in summary, higher yield on 10-year treasury is what? Bearish for stock. So yield and stock they move in opposite direction. Yield and cryptocurrencies they move in opposite direction. So if you must forecast the stock market and cryptocurrency market, it is number one thing you need to watch out for right now before you probably take a bet on any stock or any cryptocurrency. So I hope this video shed more light. I hope this video has opened your eyes to the leading indicator that you need to actually forecast the stock and also cryptocurrency.